Good day, participants. Today we would be talking about chapter number 11 of CFP2. Chapter number 11 is life insurance policy selection. Now this chapter contains topics like determining the cost of life insurance, how to determine the cost of life insurance from the point of view of the customer. This is because here we want to be talking about the pricing of the insurance, which is as per the actuarial principles. That there is a separate chapter for that. In this case, we will understand the need for a selection of a particular policy on the basis of the cost. So, therefore, the financial planner can also suggest to the client, or the client himself or herself can evaluate the cost of the various insurance. Then we would be talking about cost comparison method, how to compare the costing of other various plans. What are the various methods of such evaluation of the cost comparison? Return on savings. So if one has to calculate what is my return on the saving component, that is, for example, in endowment plans, then this also the client can calculate. And then we will be talking about what is the taxation norms for the life insurance and what are the factors to consider while buying a life insurance policy. So one by one we will be taking the topic. First of all, we would be talking about determining the cost of life insurance. Now, broadly, we can divide life insurance plans into two kinds of plans. As you know, one are endowment kind of plans and the other are term insurance kind of plans. In a term insurance, there is no maturity value, and so therefore, whatever premium is being taken from the client is the mortality charge plus any expense, all expenses. Expenses include the administrative expenses, underwriting expenses, the processing of the proposal expenses. Whereas in the case of endowment plans, as we know, that besides these two expenses, mortality as well as expenses, the third component is the saving component. Basically, this is the saving component which earns an interest or which earns returns, and in turn gives a yield. This yield in turn is responsible for giving the maturity value in the policy. So therefore, when we are talking about how to calculate the cost of life insurance, in a very simple form, we can say that cost of the life insurance is the difference between the paid premiums from the point of view of the customer. The paid premiums, whatever premiums, suppose I have bought an insurance policy, so whatever premiums I have paid minus, basically we are saying, because in these plans we are also getting back some value. So if we want to calculate the cost, so from the point of view of the layman, we can say what are the premiums I have paid minus whatever money which I have received in terms of maturity value, or we can say in the form of cash value, because maturity, if I am continuing with the plan till the end of the term, then I get the maturity value. If suppose I want to discontinue the plan in between, then I will get the surrender value. So we take minus cash value. So cash value can be either surrender value or it can be either maturity value. So this is simple for simple understanding for a layman. That so this would be the cost of buying the life insurance. Now in the case of endowment plan, the cost of a life insurance premium which an insured has to bear is the cash value minus the premiums paid, or paid premiums minus cash value. This the client would be knowing which value is higher on the two. This will vary from client to client. Whereas in the case of term insurance, as we know, there won't be any cash value. So therefore, the cost of the insurance is equal to, the cost would be equal to the paid premiums, equivalent to paid premiums. Now, if we want to determine the costing of a life insurance, we can consider four factors. Number one is annual premium, of course, because we were talking about premium. We have to take into account the cash values, because anyway these values are being given back in case of endowment plans. Then we have to take into consideration, in other countries they call them dividends, in our country we call them bonus. Any bonus which has been announced in the policy. And last but not the least, we also should consider the time value of the money. See this in an example that why you should take time value of the money. For example, if I am investing my money today, so what my money would have been if I would have invested elsewhere. So now let's see these methods of costing one by one. There are two methods of costing, basically types of cost methods, calculating cost methods. The first method is the traditional net cost method. It's a very simple method. Traditional net cost method. And the second one is interest adjusted cost method. Interest adjusted cost method. So let's take what is the traditional net cost method. In the traditional net cost method, what we will do, we will add all the annual premiums or half-yearly premiums or quarterly premiums, whatever be the mode of the payment. We will add all the premiums paid by the client. Then we take into account what is the cash value in this policy. For example, what is the maturity value, or what is, first of all, let's take what is the bonus announced in this policy. If it's a participating policy, then there would be some bonus also in year to year. After the valuation, some bonuses would be announced by the company. So add all the premiums, say all the premiums are, let's take an example to understand this. Let's say that there is an endowment policy in which the annual premiums are, say, rupees 10,000 per annum. Let's say the sum assured of this policy is rupees 2,50,000 is the sum assured, and the term of this policy is, say, we will assume some amount of bonus. Let us assume that bonus received, total bonus received in 20 years are, say, 25,000. We are just assuming some figures. Now, how to calculate the cost of this insurance? How much annual premiums this person has paid? 10,000 multiplied by for 20 years this person has paid. So total premiums paid are 2 lakh rupees are the premiums paid. Okay. Now this method says traditional net cost method. Okay, cash value including expected bonus to be received at the time of maturity of the policy is to be subtracted from the total premiums to be paid. First of all, let us subtract the bonus which he will receive after the end of the policy. Bonus we have assumed 25,000. So his costing comes to 1,75,000. Now this method says you deduct the maturity value received. Now in this case of a government plan where the sum assured is 2,50,000, after the end of 20 years this person will receive the same sum assured. So less 2,50,000. So this is 75,000 minus. Basically this method says that rather than having a cost, it's the client is not incurring any cost, rather he is getting 75,000 more in this kind of plan, and this is the cost for 20 years. So therefore for 1 year, what is the cost? 75,000 minus 75,000 upon 20, so which is minus 3750 is the cost per year, and this is the cost for, say, and for an insurance of 2,50,000, the cost is minus 3750. So for a sum assured, because the standard in any kind of standard tabular premiums, the premium rate is calculated on per thousand sum assured. So for per thousand sum assured, it will be upon 2,50,000 multiplied by 1,000. So this would come out to be around rupees minus 15. So per thousand sum assured. So this is a very simple method, traditional net cost method, that what is the cost of premium paid, you deduct what is the value you are receiving. So this is one method. Now let's make a quick comment on this method. What do you think? Is this method right, or there are some flaws in this method? See, this method has got, you are thinking right, this method has got several drawbacks. Number one, the time value of the money is not considered, the basic thing. See, we are saying that there is no cost to the insurance, it's in negative. But rather it's not taking into consideration that had this 10,000 rupees been invested every year in some other plan, let's say in some annuity plan or in some other recurring deposit. So in 20 years, what this amount would have been? That interest amount has not been taken into consideration, number one. Number two, since it is saying that there is no cost to the insurer, rather the cost is negative. So this also seems to be quite impractical. Rather there should be a cost to insurance, and this is not easy to resolve basically. Then this illustration also, here we have said okay, 25,000 is the total bonus, or every year some constant bonus would be announced, but practically bonus amount is not constant. It varies. Sometimes there could be bonus, there could not be any bonus. Had there been no bonus, then this 25,000 we would not take into account. Then the cost would have been somewhat different. Then we have taken a basic premise that the policy will continue for the full term of 20 years. But for suppose there are 100 customers who have bought this plan, there would be some customers who may not continue this plan for the full term. They may surrender the policy in between. So the company would have to give them surrender value. So that costing also has to be taken into account. So therefore, now we have the second method. So in order to remove these drawbacks, the second method, which is known as interest adjusted cost method. So this method takes into account the time value of the money, and it applies the interest factor to each element of the cost, and it makes use of interest adjusted cost indexes, namely the surrender cost index and net payment cost index. Now let us see the same example let's take the same example to the next method, interest adjusted. In interest adjusted method also, as I have told you, there are two methods: surrender cost index method, and the other one is net payment cost index. First of all, we will net payment. First of all, let's see surrender cost index. Let's continue with the same example. The annual premium every year is 10,000. So, if we consider that the rate of interest which would have earned on this is premium is, let's consider a rate of interest as 5%. Then if every year if you deposit say 10,000 every year for 20 years, then what would be the cost of this? It won't be 2 lakh, it would be, so we will take the factor which is the accumulated value factor. We can calculate it also, or we can see it from the compound interest table. We are assuming an interest rate of say 5%. So for 20 years, if 1 rupee is invested for 20 years at the rate of 5%, then the accumulated value SN would be 33.066. So this is the multiplicative factor. That is, if one is depositing 1 rupee every year for 20 years, then actually he has deposited 20 rupees, but it would become 33.0660 at the rate of 5%. If we consider at the rate of 6%, then it would become 34.868. Anyway, let's take an example with 5%. Right, because these 3 decimals will go in 0. Okay, right. 3,30,000 is the cost now. Now, out of this cost, what we are going to do? Let's consider that okay, the bonus was 25,000. Now here also 25,000. It's not given. It's not announced at the end of the term. Rather, bonus is announced. Bonus rate is announced every year. So we will have to consider that how much is the bonus announced every year. Let us take the same example. If suppose, let's say, the bonus was announced at the same rate, so divided by 20. Let's assume that 25,000 divided by 20, so bonus was announced at the rate of 1250 rupees bonus was announced. So here also we will take into consideration the time value of money. So this also should be multiplied by 33.0660. This will also give multiplied by 33.0660. which would give, so minus 4133 rupees, 2,89,327. We are omitting the amount of paisas. Now here we are saying that the maturity value is 2,50,000. So this is 2,50,327, 9. So 39,327 for 20 years. So for 1 year it would be 39,327 upon 20. So this is 2 1 are 2, 2 9 are 8, 6 are 12, 2 6 are 12, 2 3 are 6, 10 2 5 are something 1966 per year. So similarly we can calculate it. 1966 is the cost. 1966 is the cost for 2,50,000. So for 1,000 the cost is coming to say 7 rupees. So this is the method which has taken into consideration the interest factor also. Now in this also there is another method, because we are talking about surrender cost index. What happens if the client surrenders the policy in between? So that cost also has to be factored in, because all the policy holders may not continue for the full term. So how to factor this cost? So in that case, the insurance companies or the clients, what they should take into consideration? Instead of dividing it by 20, this cost, so we can also take the accumulated value of 20. We can also include the interest factor. I mean, this is a mathematical formula, so it's a mathematical, you can say, norm. That surrender cost factor will be taken care of. So 39,327, instead of dividing by 20, we can divide by the same factor, 33.0660. Then the cost would be still less. It would be 1189.35 instead of 1966.35. So basically these are the methods where you can take into consideration the surrender cost index also. So these are two methods. Then let's talk about net payment cost index method. In net payment cost index method, only difference is that this maturity value is not reduced from the cost, rather it's based on the net payment itself. So we don't reduce the cost. So here the cost would be higher. So these are different methods to calculate the cost. So majority of life insurance customers use premium as a basis of cost comparison of various plans. But net adjusted cost data should be used for comparing costs. So many times it becomes pertinent to know what is the return which we are getting on our savings company, because the client should be made aware of the fact that it would be unfair to compare life insurance with other pure investment instrument, because life insurance also has a cost factor which is known as the mortality cost, and then it also has to factor in other expenses on underwriting costs. And so therefore it is important, while we are comparing one life insurance instrument with other saving instrument, then we should compare on the cost, on the saving factor alone. So now this chapter also talks about return on savings account, that rather than calculating the return on the full premium, we should calculate what is the return on our savings account. Here also there are two methods. One is yield method and other is annual rate of return. Now what is yield method? Yield method is defined as the average annual rate of return on an endowment policy. So when we are talking about annual rate of return, we have to take into consideration two major components in these kind of plans. Number one is the protection element, which is for the coverage of the risk, and other is the saving element, which would be invested so that it can yield returns. When we are talking about yield method, the client should take into consideration the fact that in a typical life insurance policy, during the first 3 years after taking the policy, there is no surrender value payable. So therefore, when we are calculating the yield, we have to take into consideration that the return, if any, has to be given after the first 3 years only. Or so therefore we can say that during the first 3 years of the policy, the annual rate of return would be negative. Nothing would be payable to the client in case he or she surrenders the policy. And in the first year, the negativity can be 85% to 90%, because it is said that in a typical endowment policy, 85 to 90% are the expenses incurred by the insurer. And so the returns in the policy starts increasing year by year, and especially after the first 3 years. So therefore all those considerations are to be taken into yield method. Now exactly how to calculate the return, that we will consider under the second method, which is known as the annual rate of return method. As a client, I am interested to know what is my annual rate of return. The insurance company might say that yes, your overall return was this one, but I want to know because the rate of return would vary from year to year. Because as years pass by, the expenses go on reducing. So therefore, the annual rate of return would also vary. And the bonus rates, since the bonus rates also vary, so therefore, in order to calculate the rate of return in any particular year, there is a formula. Let's see what is the formula for the annual rate of return method. So annual rate of return is equal to cash value. By cash value mean either the surrender value or the maturity value. Cash value plus bonus plus risk premium. What is risk premium? Since it's an endowment plan, we have to take what is the mortality cost. So that is the premium which is paid to cover the mortality risk of a client is known as the risk premium. Into death benefit. Death benefit is basically it's the sum assured of the policy. Minus death benefit is basically sum assured. Minus the cash value. Again, why we are taking cash value here? Mainly it will be surrender value because we are calculating in a particular year. Multiply by 0.001. Divide by annual premium paid plus cash value at the end of preceding policy year. Plus cash value at the end of preceding, that is in the last policy year. All this, then you have to minus it from 1. This has to be subtracted from 1. If we take a very quick example in order to calculate the annual rate of return. Let's say that there is a policy with a sum assured of 3 lakh rupees and the term is 25 years. This was bought by a client who was at the of age 32 years, client age. Now after say 14 years, now the client's age is 45 years. Now client wants to know what is my annual rate of return at the beginning of the 14th policy year. At the beginning of 14th policy year, what is my return? So for this, the client should take the following information from the insurer. Number one, we have to know the following data. Number one, what is the annual premium? Because we say annual premium is say 20,000, and the cash value, that is what would be the surrender value if the policy is surrendered in the 13th policy year. Because he wants to calculate the return in the 14th year, so he should know what would be the surrender value in case the policy is surrendered in the 13th policy year. Now this involves a lot of calculations. Let's say he has come to know from his insurer that the surrender value in the 13th year would be say 75,000. And what would be the surrender value at the beginning of 14th year? This is beginning of, and this is beginning of. So he was told that your surrender value would be 85,000. Plus risk premium on his present age is 10 rupees. Risk premium per thousand. Remember, this is per thousand in formula. So per thousand is 10 rupees. Multiply by death benefit, that is sum assured is 3 lakh. 3 lakh minus, again cash value same, 85,000 into 0.001 divided by annual premium paid. Total annual premium paid is 20,000. plus cash value preceding, that is in the 13th year, what is the cash value? So if we calculate it, this will come to 7.74. Now in this formula there is minus 1 also, so you have to deduct it by 1, so this is 6 point. So basically this is saying that the return in this particular year is, so this is one of the formula to calculate the return. Now coming to the next topic of this chapter, it tells about the taxation of life insurance, which is very important from the examination point of view also, and which is very important from the practical point of view also. What is the status of regarding taxation of life insurance? Well, there are two very important sections of Income Tax Act 1961. The first section is Section 80C. Section 80C states that any savings done in various instruments to the tune of ₹1 lakh per annum would not be included in the taxable income of the assessee. So it says that rupees, or in other words, ₹1 lakh of savings in specified instruments would be directly deductible from the annual income of the client. And one of those saving instrument is life insurance. So if the client invests his ₹1 lakh in any life insurance policy, so therefore he can directly claim the deductions from his annual income. And recently, in the recent budget, any premiums paid for annuity plan or the so-called pension plans of life insurance companies would also come under Section 80C, although they are dealt with Section 80CCC. But now 80CCC has also been merged with Section 80C. Previously, the maximum limit in the pension plan for Section 80CCC was 10,000 rupees. But now instead of 10,000 rupees, it has been made ₹1 lakh and it has been merged with Section 80C. But this ₹1 lakh includes premiums paid for life insurance plans, premiums paid for annuity plans, or any other investments done in, say, PPF, in Employee Provident Fund, in additional saving certificates, for the tuition fees, education tuition fees for 2 children, or for the principal amount repaid for the housing loan, or for a bank draft exceeding 5 years, or for infrastructure bonds, or for equity-linked savings schemes. Another important section for life insurance is Section 10, subsection 10D. As we know that Section 10 deals with the taxation status for the interest earnings or the earnings on investments. Section 10D particularly deals with the income earned from life insurance. So any interest earned or income earned or returns earned from life insurance is dealt with Section 10D. Section 10D states that any life insurance proceeds, whether by death claim or maturity claim, would not be taxable. No income tax would be charged on the life insurance proceeds. Now, let's talk about medical insurance also. This was about life insurance. There is Section 80D, which deals with any kind of health insurance plans or mediclaim plans. There is a separate section for this. So any premium up to a maximum of rupees 15,000 is liable for deduction from the annual income of the client. And for senior citizens, the limit is 20,000. There is another important section when we are talking about the taxation, that is Section 80DD. Section 80DD deals with insurance plans, with those insurance plans which are specifically meant for handicapped persons, physically handicapped persons or spastic persons. So for them, if an insurance policy is taken on such persons, then an additional premium, this is apart from this 1 lakh of 80,000, then any premium up to the limit of 50,000 on such persons is directly deductible from the annual income of the person. And for specified handicapped persons, this limit can be up to 75,000. So that means premium paid for such handicapped persons. The caretakers of such persons can take the policy and they can claim the income tax benefits. Now we come to our last topic, which is what are the factors to consider while buying life insurance. Overall, we have now studied so many chapters about need analysis of insurance, about identification of risk exposures, risk management, etc. So we will talk about the basic ingredients to consider while buying life insurance. Number one step is the client should consider that, should calculate or should find out whether life insurance is needed or it is not needed. That is the basic thing. As we had talked in our earlier seminars also, that it could be that there is no need of life insurance on a particular person. So first of all, one has to find whether life insurance is needed at all. So that will be known only after the complete analysis of, by various methods, which we have already discussed in our earlier webinars. Then second step is, for example, it has come to be known that okay, life insurance would be needed. Then one has to calculate what would be the amount of life insurance cover which is required to be taken. Number third step is the client has to select and analyze the appropriate type of life insurance plan. Whether I should go for an endowment plan or a whole life plan or a term insurance plan, and then also according to one's risk appetite, whether one should go for a ULIP plan or one should go for a conventional endowment plan or one can go for a variable insurance plan. So accordingly, as per need, as per paying capacity, one has to select the appropriate plan. Now, next step would be one has to choose whether one has to go for participating plan as non-participating plan as per the payment capacity, because different plans have got different premiums. If you want more SOPs out of a plan, then definitely you will have to shell out more premiums. And then you have to make an appropriate cost comparison also, because it's not necessary that okay, the premium of one policy is say 20,000 rupees per annum, the cost of the premium of another policy is coming out to 70,000 per annum. It's not necessary that 17,000 per annum policy would be cheaper. You have to calculate the cost benefit. You have to do a cost benefit analysis basically. What are the benefits given under this policy? What are the bonus rates given under this policy? What are the various coverages given under this policy? Whether riders are also covered under this policy or not. So, and then according to our different methods, maybe traditional net cost method or interest adjusted cost method, you have to make an appropriate cost comparison. Then finally, yes, of course, goodwill of the insurance company, the financial strength of the insurance company, the image of the insurance company. Then if you are really interested in technically analyzing the company, then you have to see the rating of the company as per the rating agencies. You have to look for the solvency ratios of the company. If you are going for a very long-term plan, maybe say whole life insurance, then sometimes the client is apprehensive whether this company will sustain till that time, whether it will exist at that point of time or not, whether it will, or even if it is existing, will it be defaulting on the payments? If I am not there, I am taking a life insurance. If my if my dependents will not get that claim, then what is the fun in going about this insurance? So that means the solvency or the credit rating of the company is also assumes great importance. And then one has to deal with qualified, ethical and competent intermediaries. So intermediaries are also important, whether one is buying from an individual agent or from a broker or from a corporate company. So that also is very important in today's times, because there are a lot of we hear news that a lot of mis-sellings are going on in the market. So in order to avoid all those mis-sellings, one has to choose a intermediary based on past experience and based on his goodwill. Thank you, participants. I hope this session would have given you more insights into the nuances of insurance. Thank you very much.